Transfer pricing is a very important part when you look into whether we call it a maximizing or whether deduction or managing your tax rates. Transfer pricing, the bombastic word, everybody think very hardly whether it has anything to do with them. Okay, so what is transfer pricing, ladies and gentlemen? Transfer pricing generally refers to intercompany pricing arrangement, for a transfer of goods and services and intangible between associate person. Ideally, the transfer price should not differ from the prevailing market price. Okay, coming back to just now we talked about the deemed interest, ladies and gentlemen, the deemed interest. So if that set of account, I got directors borrowing, okay, which under 10 how do you call, under my section 140, I need to actually impose a prevailing interest rate. Okay. Then when I look into the related party balances or related company balances, associate company balances, okay, what rate should I use? So if we go by the principle of arm's length, if we go by the principle of transfer pricing, we talk about if you're using prevailing rate for the calculation of the deemed interest, most likely you'll be using the prevailing rate to calculate the rest of the other, deemed interest approach together. Okay, it will be weird if you're actually using a different rate as well. Okay, unless there is an agreement to support why it is so. Like for example, for deemed interest now is still not too high. I do a 2% or 3%. For my related company, I do a 18% because it is a Along rate. Okay, as an Along, I can do 18%, so I do an 18%. Okay, I guess you got to actually have an agreement to do that. Yeah, ensure that you have documentation to support why it's actually that way, and etc. etc. Okay, now examples of what we call associated person. Okay, so basically company A control company B and C via shareholdings, and then therefore B and C is what we call connected or associated person to one another. They are having control with each other. So this is what we call item that will actually pretty much come under the withholding tax. Okay, now withholding tax, transfer pricing. Now transfer pricing, basically the Inland Revenue did do quite a fair bit. They have this very wonderful and colorful flow chart to explain, very easily to understand and very good to use. Okay, so we wanted to just zoom into the important parts. Okay, now do you meet the threshold company? Do you meet the transfer pricing threshold to begin with? So the transfer pricing threshold, we are talking about your gross income is 25 million. Business income, if you have this interest income or whatever set aside, dividend income set aside, we're talking about business income more than 25 million, or you are having a control transaction. You don't hit the business income or 25 million, but you have a control transactions between the company, which is 15 million, or where a person provide assistance, financial assistance, such financial assistance that is exit 50 million, okay, then you need to actually have a TP doc. Okay, you need to have a TP doc. So if you have not hit the threshold, if you don't come under any of these, right, you are still required to prepare minimum TP document. But you are always encouraged to prepare a full TP document. Okay, now, however, for person who only engage in domestic controlled transaction, they do not have to prepare a TP doc if it can be proven that any adjustment made will not alter the tax payable or tax suffered by related person. Now, this is the interesting part. Sometimes I need to do an advancement, right? Like the case study that we mentioned about our deemed interest, related company. Do I need to do deemed interest, right? Do I need to do a calculation of interest, or do I wait for the Inland Revenue to come to me and use their power to actually calculate for me? In the event of audit, what do I do? What is arm's length transactions, right? So if one company is loss, one company is profit. The profit company is the one have money. The profit company is the one who lend the money to the loss-making company. and the deemed interest, or rather a computation of the interest, may be imposed onto you in the event of audit. Why? Because by doing this, right, this side I may not be collecting it, but I will be collecting tax from here, no? Right? So if you are not able to demonstrate both are profit, no matter how I shift, right, domestic only, no matter how I shift, there's no tax implications, okay, then the power of the DG may be kickstart anytime. So TP document is important because of this. Okay, important policy need to be crafted. So related company, whether you are Senan Berhad to Senan Berhad, whatever it is, I strongly encourage you still having this TP document. If you want to know more about this particular support, please contact Syarikat Ong. Yeah. Okay. Now, what if I meet the threshold? Everything, the item 1 and 2 here, you have met. Okay. Then basically a full TP document required to be done. Okay. Now, submission of transfer pricing document. A lot of time is like, transfer pricing at the moment is like this. Okay, inland revenue better don't find me, like a hide and seek. Don't find me, don't find me, don't find me. Okay, but if they come forward to you and they actually ask for your TP document to be submitted, they actually wanted it within 14 days. And if it's not being given to them within 14 days, the fine can be 20,000 to 100,000, minimum 20,000, ladies and gentlemen. And 20,000 we have seen it. Actually, we have seen it. Okay, so it is not just hearsay. They really do charge. Okay, now power of the DG, like I said, I wanted to repeat this particular slide. Okay, whereby just now we talk about the substitution. We have a situation before in the past of power of disregard that was exercised by the Inland Revenue, to be honest. On one of our clients, they are an Italian company. They set up a Malaysian branch. So at that time, we were the tax agent of the Malaysian branch before they finished their project and closed everything. So the Malaysian branch at that time was being set up to satisfy the withholding tax matters, etc., etc. So the Malaysian branch was therefore carry invoicing as well as expenditure. But the Italian company, the European company, they wanted to repatriate most of their money out. So they honestly leave very, very little at the branch level for it to be taxed. Inland Revenue did an audit on it, okay? And then at the end of the day, they actually did a surcharge. Yeah, I remember it was also 5% at that time, okay? So does Inland Revenue consistently using this power? I will say yes, in the event of audit, and then it may come from any one of them. So the power of the DG to disregard a structure, to do an imposition of a surcharge, or to tell you to do something, right? It is actually within their power. So when we do certain things, we have to ensure that we are always ready to explain ourselves. Okay. So power to disregard, the arm's length transactions, the power of disregard, and ability to surcharge. Okay, now very quickly, I want to do a snapshot of special tax treatment. Okay, the 3 special tax treatment we wanted to highlight is actually 33.332 interest restriction, repair and renewals. Simple, but a lot of times people don't pay attention to that. We look at GL, whatever the client gives us, we just claim, you know, sometimes, and then some more, sometimes tax com is done in a rush, or for the accountant, they don't have time to actually analyze the matter into detail as well, right? So as well as the preferential corporate tax rate, just to highlight to everybody one more time. So interest restriction, ladies and gentlemen, is actually very important. Because of MCO, I know a lot of us are actually into loans and borrowings. Okay, so generally do bear in mind that if I borrow, this is the company I can borrow the SME's loan. Okay, but I know nobody going to see this. I'm going to quickly transfer the money to another company because they need it more than me. But this is the company that can borrow, that company cannot borrow. So I'm shifting my loans around. Okay, I'm shifting my loans around. So do remember the loans amount or the investment around is actually larger than the amount borrowed. Okay, the interest generally is 100% not allowed. Okay, now, so what if it's partial, meaning the amount, the investment sum sitting in your balance sheet, as well as your advances that you actually give out, all right, is actually lesser than the borrowing amount, then a formula, should I say, a formula will need to be imposed, and then a portion of the interest expenses is therefore will be disallowed. Okay, so a portion. So there is this formula that is actually there. If any of you wanted to know more also, again, feel free to talk to us regarding the matter. Yeah, we can feed the information to you subsequently as well. So, okay, now what would be not under this, these interest restrictions? If your interest is actually does not exceed 10,000 in the cases of company and not exceeding 6,000 in the cases of individual and others, then these restrictions, this what we call A over B times C calculation doesn't need to actually apply. And then if it's also proven for the cost of investment that was actually not funded by the borrowings, you can also skip the calculation of interest restriction on the borrowing interest that is sitting in your book. Now, item number 2. Why I don't say advances? Because advances is something that is not easy. It's not easy to identify unless you can really prove it. Otherwise, the inner revenue prudent basis, they will still expect that the other debtors or the advances to directors or how do you call advances to related company or related parties, right, is part of the computation of disallowance of tax, restrictions of interest onto you. Yeah, so do bear in mind the moment that you use borrowed money to shift around your group, this become an additional expenses for you. Yeah. Now, repairs, this item, what is come under revenue expenditure and what comes under capital expenditure? Public ruling 2019 actually came out. 6/2019 actually came out. So basically, this is a snapshot of what is actually in the rules. Do bear in mind that existing condition is important, right? Or alter the original condition will actually make it a capital allowance, capital expenditure in nature. So pay attention to this list. I won't go into detail because I believe you'll be able to read it on your own. If any of you wanted to know, to actually have an additional slide from us, we are more than happy to pass it to you, yeah? But however, you will need to actually fill out our survey form or feedback form in order to get a copy, yeah? Now, tax rate, ladies and gentlemen, very quickly, since 2020, there are actually 2 categories of tax rate that we are actually talking about. Category A, we talk about SMEs. Okay, nowadays we don't call about SMEs anymore. We talk about 2.5 million and below paid out capital. And at the same time, all right, the income does not actually exceed 50 million. Then we are talking about you're still having the preferential tax rate of 17% for your first 600,000, balance 24. Okay, if it's more than that, then it will be different. So category B, we talk about the inner revenue have changed to say that even though you're a small company, but by virtue you are an investment holding company or you are an LLP, whereby without gross income, but actually having rental and interest, okay, then basically we are talking about a flat tax rate of 24%. Okay, over here, we're going to do a very quick snapshot of, in case you are an SME, maybe you are a partnership, maybe you are Sdn Bhd, or you are in the midst of, should I actually change to Sdn Bhd? You are at that stage of your business, of your decision making, right? We wanted to give you a quick scenarios of this taxable income range and what may be the tax that is imposed. So we talk about sole proprietorship structure, we talk about partnership structure, and we talk about Sdn Bhd or LLP. Yeah? Okay, this one we go by the fact that you actually have a preferential tax rate of 17%, and we talk about these 3 colors: lowest tax payable, moderate, and highest. Now, we realize that when the chargeable income is 28,000 and below, Sdn Bhd already have taxes, but sole proprietorship as well as partnership hasn't have it yet. When you hit 35,000 chargeable income, we realize that sole proprietorship you're starting to have, but of course partnership you still don't have, Sdn Bhd you have. Okay, 150,000. Okay, then we realize that as far as tax is concerned, yes, Sdn Bhd is still at the top. Sole prop is catching up at 150,000, and partnership, because it's split into 2, so it still haven't actually hit it yet. Okay, but the moment that you hit 200,000 chargeable income, basically sole proprietorship is already more expensive than a senior broad. This is the point that you may want to decide whether do you want to convert from your sole prop structure to a senior broad or not. Okay. Now, when you are 400,000, generally you are quite high already, and then you will realize that partnership is also more expensive than a senior broad already. So, ladies and gentlemen, this is just a quick snapshot to tell you at which point you wanted to change your business structures. Yeah. The last part basically of our discussion today is improve your documentation and manage your tax audit situation. I think I have already somehow and somewhere explained here and there, right? So very quickly, this part I want to make it slightly more lively. Yeah. So how to improve your documentation? We do a quick, simple case studies. It is all about proof of payments generally. If we are talking about a company that have actually engaged on non-residents, yeah, to provide services, etc., then we are talking about situation whereby your contracts will need to be ready, proof of payment need to be there, receipts of withholding tax is very important, and then any other document that may be able to support. Okay. Now, this is our real life case, whereby a company employed 50 foreign workers to work on a shift at their factory. Their monthly wages are paid in cash by the director. So what happened is the director will always, the finance will always hand one stack of cash, okay, to the boss. So the boss will take the cash and they start, that is what we understand from the taxpayer, okay, and then they will give, and then maybe the foreign worker will sign off, okay, and then that's it. Actually, when this thing came to the tax audit actually was questioning about the genuinity and whether the 50 foreign workers is actually there or not. Okay, because how do I know that out of the 50 foreign workers, 10 is actually phantom workers that the directors is trying to sneak the money out of the picture, right? So that is like the curious mind that the authority was actually having. So basically, what is important is, do you have any other documents in order to prove that you genuinely have your 50 foreign workers, like punch card or any other timesheets, any other form of recording? Yeah, because you know, foreign workers, of course, they need to be licensed. But what if some of the foreign workers just come to your door and you decided to use it because you are SME, you say, I got no time to actually go and look into the levy. Okay. Under what circumstances? The worker payment is genuine. The person may not be legal. But however, when it comes to the audit, what is going to happen to the transactions? Is the signing off of the voucher is sufficient or not? Honestly, it may not be. It may not be. So we were wondering whether this can be done. Maybe a wallet, at least a wallet, I don't know. Okay, any way to take advantage of the online banking in order to at least create an audit trail. Today, maybe the Indian Revenue can still talk to you about it, but it's in a matter of time when things are becoming cashless in many ways, right? I think how we actually treat all this documentation is another topic that a taxpayer should discuss on.